supply. If you suddenly change the demand, the supply will try to adjust. You know, risky companies will delever if everybody buys low vol, right? They will issue more debt if people like to buy more bonds and deviate from the 60-40 portfolio. So, but that takes time. And I agree with Aaron that over time the market will rebalance, but during that will be a long time period, and during that period, there will be opportunities to harvest.
And the way I see it is that, you know, we have seen all of us seen Ibbotson chart, which shows small cap doing better than large cap, equity doing better than fixed income. So this is being published for last 50 plus years, but no one is just putting everything into small cap. The same thing is going to happen here. You'll see that factor-based investing, some factors are good, some factors will have the cyclicality, and these are additional tools for portfolio diversification, robust optimization. But the biggest challenge will be that most of the pensions don't have the governance structure. CIO life is shorter than life of a, I don't want to say US president, but so by the time the new CIO comes in, what he's going to do is going to say, oh, I don't like this strategy, I don't like this factor. They're going to go away with that. So as long as the pensions have a more robust governance structure, these are nice to have. And some bigger pensions will try to change and they will try to harvest it, but they're more sophisticated. For mid-sized pensions and even for retail, this is a little bit of a tricky proposition, because if they're just chasing performance, which is what more the retail market is, they'll go for one factors and factor crowding will happen. They'll be late in the game and they'll start burnt, and then they'll start go for the next factor. So it's better to stay away if you don't understand this thing. Getting the market return is the most easiest. Capturing the global beta, go into the very global beta, very broad diversifying, including developed, emerging, frontier market. You will get 6 to 7% of annualized return, peace of life, and retire happily. If you want to be a hedge fund like guy who can go and try to get this thing in market time the factors, it's a little bit riskier.
Maybe there are some questions from the audience. Yes.
I have 2 questions. The first emerged for me when Anthony was discussing the bonds that would be thrown overboard from his firm.
By the index rules.
Basically, you seemed, in my understanding, seem to be talking about fallen angels.
Yeah.
And for fallen angels, there is a strategy that, in fact, they will recover more often than not, as opposed to those that were already always below investment grade. Is there some reason that that group was thrown overboard, so to speak, by your firm in other areas which have similar risks and similar timing problems in terms of the when, not the if, why that specifically was listed?
So I was giving that as a simple example of temporary, if you want, demand-supply imbalances that can be created by certain events. In this particular case, you have a very well-defined index that has rules that say this is an investment grade index, and if a company gets downgraded to below investment grade, then the index will sell it, right? And there is a lot of money on these indices, and because people sell them at the same time, then there is the selling pressure depresses that bond, the price of that bond artificially, if you want, beyond their fundamentals, and therefore the likelihood it will recover later is higher. Not everything, recover part of its value. So it's been essentially goes below where it should be, and then it bounces back. I didn't say that it's going to be profitable to buy it because there's a lot of liquidity cost associated with these bonds. I said that it could be an interesting idea. Yeah.
Yeah, it still was surprising to me that a firm the size of yours didn't just create a division that worried about that part that was getting discarded, because there is money being left on the table.
I mean, this is the rules of the index. You know, all sorts of indices, you know, have this artificial. They are not smooth. The rules are, you know, they draw lines, right?
Yeah.
So everything that crosses the line.
It struck me as unusual that that specific one was pointed out. Okay.
I mean, we have written a paper on that. You can write about that.
Maybe your choice was more significant The second question is really more for the entire panel. And this is, I've been going to these for many, many years on both sides of the table. And something that I've never really heard brought up or further explained was the tracking error idea. In Markowitz's book, he mentions the semi-norm, which would give an opportunity to not penalize for when you're tracking above where you want to be as opposed to below. Why do we persist in leaving that out?
I don't know if it's on point for what we've been discussing. Does anybody want to address that?
And I think, unfortunately, I think that's a longer answer. I'll only talk afterwards. There's a lot to say about it. I agree. I would just toss one thing in here too. The index funds dumping things that leave the index is probably the most obvious and straightforward example of price pressure. There's price pressure all over the place. It's not just Anthony's firm in index funds. Virtually every investment manager and virtually every product has some pressure to dump. Retail investors have predictable things to dump, and price pressure is a whole universe of strategies, and it's real and it's big.
Correct.
Other questions? Yes.
I'd like to ask a question related to how is this going to impact the industry. You guys spoke about this quite a lot. But what we see on the passive side is that there's a concentration of product in a few names, in a few firms that essentially have most of the volume. But one could argue that at the end of the day, it's not so easy to differentiate between the different passive products. If it's a world index, it's a world index. There's not a lot of differentiation. But when you think about smart beta, your definition, Aaron, of momentum versus the definition that Anthony may have of momentum may be slightly different, and that slight difference may actually make a difference in terms of the returns of that strategy. Do you believe there is space for differentiation in the smart beta world, or will we also get to a world where a few firms have most of the assets and everybody else is left hanging?
That's a wild guess here I'm making. I think in equities, we're going to see a lot of proliferation just because you're absolutely right. There's so many ways to do it, and it's so liquid and a lot of different flavors. The real promise of these products is in non-equity markets. Equities are already chopped and sliced and diced so many ways, and they're so cheap to do this. But somebody trying to, let's say you're just a pensioner, you say, okay, we're going to do a 10% allocation to commodities. How do you do that? I mean, it's not, with equities, it's easy, right? You have this default choice. You just go for an index fund, and people have to convince you to get out of that. In commodities, you're going to people who say, I have no idea how to do it. Explain to me what an index is. What's an index in credit? I just want credit exposure. How do I do it? Even bonds, what's the global market index for bonds? It's hard to, even if you just restrict it to government bonds, it's not a simple question. If you go for market cap, then you're overweighting the troubled credits that are dumping bonds and so forth. So I think outside of equities is where we may see the dominant giant firms emerge, 3 or 4 different players that dominate because they're cheapest. Everybody agrees how to do it, and they're biggest. They have the economies of scale, and they're cheapest, and and you never get fired for choosing them.
Can I add to that? It's every meeting I have, people ask me to create an index that will use it to measure the performance of the various alternative managers. It's extremely difficult. I mean, even a simple, let's say, on the beta space, a risk parity index across all asset classes, like what Aaron said, there's so many details in how you're going to estimate the correlations. How are you going to which asset classes to include, right? Do commodities have a risk premium? I don't know. I mean, spot commodities. It's not clear if it's a risk premium or a hedge against inflation, which you have to pay to get it. It's not clear. So I doubt that any time soon we will have a successful index that everybody recognizes. We'll try to come up with something. But everybody's getting into the game. All asset managers now, every big asset manager is trying to launch something like that. So there will be a lot of development in the industry.
One thing which maybe, Sebastian, you're from Axioma, I'm from Bara. So if you look at the definition of factors, it's the same. The descriptors of how do you define value, momentum, or even private real estate and commodity, everything is the same. Now the question becomes, you can take those descriptors and then try to work around that, and either rebalancing and leaving with some stocks, And that will start to differentiate between a manager, one manager versus another. But these are risk factors. You're getting compensated for taking that risk premium thing.
Yes.
Yeah, I have a question to the panel, and that is, what's the systematic risk which would come up if investors start using this product? And could this potentially trigger a black swan event? And if yes, what's the way to hedge it?
I think the systematic component is leverage. So if investors start pouring money into these things, it's not so much, I think there's enough difference between them. I don't think we're going to see that, nobody buys large caps anymore. But what we are going to see is an increase in leverage. Much of it in the hands of managers not really experienced with leverage during crisis times. And if you wanted to posit, if you told me there was a crisis, this brought down the financial system, that would be my explanation, that we had a real leverage crisis. People pulled out of these strategies all at once. People couldn't repay their, maybe a futures clearinghouse fails, maybe a prime broker fails or something like that.
Well, liquidity crisis is the biggest one. We saw that happening in 2007, 2008 around momentum strategies, where people have to start selling their good part of the equity holdings when the short squeeze happened. So even in the equity space, without the leverage, on the short side, you can have...
to leverage.
All crises have to do with leverage.
Yeah.
Yes.
In thinking about talking to clients on forward-looking Premia, how much do you guys think and worry about flows? So to be more specific, you guys talked earlier, you said there's plenty of capacity, and you also said it's very hard to time these Premia. On the other hand, if you take like the prototype, take the lowball anomaly, for example, where you guys also said you need to know who's on the other side of the trade, right? So you guys, Aaron's colleagues wrote some really good stuff on thinking of, leverage aversion and lottery seeking drives that, right? So assuming there's a finite amount of people who have those types of aversions, and all of a sudden a whole bunch of money comes pouring in on the other side, isn't it just a tautology that the premium's going to go down? Maybe not to zero, but certainly less than what had been manifested historically.
The way I would say, what you hope happens there is that you get some inflated returns for a while because money is rushing in. So that's self-reinforcing, but it stabilizes. Then there's a period of mediocre or poor returns. The danger is it gets too extreme and you get a bubble and a crash. I think it's perfectly possible we'll see bubbles and crashes in some of these. The point is, if you bet all your money on one of these, you're a fool. The whole point of this thing is for diversification. And if you have a lot of them and you have the sensible attitude, yes, there will always, it's incredibly tempting to try and guess when it is and look at the flows. Certainly as a risk manager, I look a lot at that and I say, okay, this was one I've got an eye on, this is what I'm worried about. But I don't think you make money timing. I think you get them all, take your losses when it happens, and hope it doesn't snowball into something really bad.
And it's not dissimilar with equities, right? Equities go through cycles, right? The risk premium can go away at times, right? When you buy at the wrong time.
But there's a lot more breadth.
There's a lot more breadth, so you have to be cognizant about the breadth of the market. There's no question about that.
So Steve, you got a question?
Well, this was a terrific panel, and everybody made so many great comments, and there's been a lot of great questions too. I'm trying to think about, as a retail investor, what would we expect to see happening? And the first thing, I'm afraid that whenever we look at how retail investors behave, it's really depressing. They just don't seem to know what they're doing, and whenever they decide to do something active, it's the wrong direction. And so
that might suit the institutional ones.
But so it seems to me that there's going to be a lot of people who would get into these things thinking that there's an alpha that there really isn't there. Now there should be some people who have particular risk preferences because of their situation, whatever it might be. I mean, we all think about the farmer ought to go hedge his crops, and the equity trader should have very little money very little of his savings invested in the stock market. We all know that equity traders don't behave that way either, even though they're directly in the market. And so, as I was thinking about how to ask this question, I thought of a thought experiment for the highly sophisticated people in the audience. that academics, as academics, we always assume people have constant relative risk aversion and optimize our portfolios based on our coefficient of relative risk aversion. And I would like people to think about, well, what exactly is your personal coefficient of relative risk aversion that you are using in making your investment decision? And I would guess you're probably mostly like me, I haven't a clue.
Yeah.
No idea.
2.7.
Right? And so the last thing is that then what I really like to hear was that there may be some structural things going on in the market where the market is perfectly happy to pay alpha to somebody who can do something, like provide liquidity. And the last question then is sort of, well, yeah, but well, if people start doing that, don't the risk premia go down? And Aaron then captured my last thought, which is, yeah, but not at first. At first we see a big pop in the returns and suddenly everybody says, oh my God, this is a wonderful factor to be in, just when the expected returns go zero.
Yeah, I think you're taking the aggregate view. If you look at the aggregate view of retail investors and institutional, has been mentioned, is pretty depressing. And all you have to do is get out of asset management if you think too much about that. Yes, there will be marginal people who buy these products and lead themselves into financial disaster because of them, and they probably would have without them, I hope, anyway. You can't worry too much about that. There are smart investors out there. There are people who do it right, and it matters that they have the tools to do it. You can't worry that lots of people are going to do things foolishly. I don't think you defend these things in a utility theory sense. The appeal of these things is for somebody who's robust, somebody who's going to say, I don't know exactly what my utility function is. If I did, I'd be looking at absolute return, not relative. All I know is I want something that's pretty close to the best I can get. If you tell me I got something pretty close to the best I can get, I can live my life happy, I'll earn, I'll save, and I'll deal with what happens. If you can take that attitude, these products are for you. And you can stick with it, which is the hard part.
However, I wanted to comment that one of your things that you said is that a lot of people, when they construct their portfolios, they ignore their own, if you want, liabilities, right? So very few, certainly nobody that I know, well, except maybe because you approach retirement, you put more bonds, it's like something that addresses your own income and liabilities. But very few institutions think, except maybe insurance companies, about their own liabilities in constructing the portfolios. I know certain university endowments that have created very interesting models that essentially put their investment portfolio within a bigger model that has their own cash flows, incoming and outflowing. How does inflation affect how much endowments, how much money they bring in, or how much they pay their they can increase the tuition, etc. These are difficult to do, but I think they're very important to do. Now, how do these alternative risk premia fall into that? Again, it's difficult because these are meant to be zero correlation to the market. But again, as I said at the beginning, you have to look carefully at each one of those. What is really the underlying risk that you are buying? Because in many of these products, the underlying risk is the market. Right? If the market falls, some of these products are going to make you pay.
From my perspective, is that the simplest beta to capture is the market beta, and even if today in the retail space, so many of the retail investors have such a huge home bias. They put 70 to 80% of their money in the local market across the globe. It's not just the US. You go to Canada, you go to LATAM, where there's restriction. So easiest to capture is the global market beta, and once you do that, remove your home bias and capture a very broad, diversified product, then you can think about anything, all the smart beta and related stuff. But the industry has not even gone to the extent of removing the home bias. They're still way far behind, and let them catch up on that, then they can think about the smart beta.
So last question, Dan.
If markets are efficient and payment of risk premia is essentially a transfer of some disutility, somebody is paying you to take something they don't want, does that suggest that long-term returns, and I'm talking decades here, are in fact predictable in an efficient market? Because long-term disutilities, what fraction of the population is taxable? What fraction of the population is of a certain age? What fraction of the population is creating cash flow or consuming cash flow? Those things are largely driven by long-term demographics. one of the presumptions of most concepts of market efficiency is that returns are unpredictable. And if, in fact, risk premia are associated with transfers of disutilities and payment therefore, wouldn't that suggest that long-term returns in an efficient market are in fact predictable?
Yeah, I think that's exactly the point, that you have this, that when you say predictable, you mean there's an expected return above the risk-free rate. You don't mean, you know what's going to happen in the stock market tomorrow. You know that small caps might have, on average, 100 basis points more, and over the next 100 years, you would expect a realization close to that? Is that what you mean? Yeah, I think that's really the argument for...
The fact that there's time variation in it, at least at a slow scale, is in fact predictable by changes in demographics, by population, by in and out cash flows from pensions and endowments, things of that nature.
I think that is the argument for these products, although not specifically demographic necessarily, but yes, that there are some long-term predictabilities, very small in the margin, very almost meaningless over a year, but over an investing career make a difference. Yeah.
All right. Join me in thanking the panel, please.
Thank you very much. Thank you, Alan. Thank you.
We're going to take a 5 minute. We're going to take a 5-minute break, and I'll start back here in 5 minutes. Thank you. I think all the speakers are going to talk for a little while. We're going to have some moderator Q&A, but we'll have time for you as well. So with that, Katherine, I'll hand it to you.
Good morning. Let me just take a quick poll, just out of interest. How many of you think that Bitcoin is something that will stand the test of time? I don't know how long, but more than 2 years.
Bitcoin or cryptocurrency?
Well, let's just talk about Bitcoin first and then cryptocurrency second. So Bitcoin, okay. What about cryptocurrency? Okay. And those of you who think it will not? Well, some of you could be undecided. And how many of you own any kind of cryptocurrency?
US dollars.
That's the end of the session right there. That's fabulous. Well, I'm just going to do a very, very brief general introduction because you've got the information in your pamphlet. But to my immediate left is my partner, Evan Greebel. We both work at the law firm Katherine, Roseman. And Evan can tell you more about what he does later, but the reason the two of us are on this panel is because, among other things, we're involved in the establishing, et cetera, the Bitcoin Trust for the Winklevoss Funds. So we're involved in Bitcoin on the legal end. To his left is Gerald Dwyer, who is currently a visiting professor at Clemson and an adjunct professor at the University of Carlos III in Madrid and Trinity College in Dublin, and was the director at the Center for Financial Innovation and Stability and vice president at the Atlanta Fed. And to his left is Dr. Warren Coates, who specializes in advising central banks on monetary policy. He's retired from the IMF, where he was assistant director of monetary and financial systems department. And he has counseled many central banks, including Kenya, and I'm pointing out Kenya for a reason. So that's the panel. What we're going to do is we're first going to have each of the panelists talk somewhere 10, 8 minutes, something like that, about particular things that interest them, that concern them. And then we're going to open up to questions amongst ourselves, but if somebody has a burning question, feel free to answer. And then we'll open it up generally to the floor. So, Dr. Coates, if you'd like to start.
Thank you very much. It's fun to be here. The weather is gorgeous outside. It might be more fun to be there. But I'm the economist, not the techie, and I want to briefly discuss what factors would give value to Bitcoin. And first of all, to clarify what I'm talking about when I talk about Bitcoin, because people very often blend together several things that are really very different. Capital B, Bitcoin is an algorithm for delivering ownership of something from someone to someone else, which in the case of little b Bitcoin is a means of payment. Like American Express is a means of payment, writing a check is a means of payment, PayPal is a means of payment. They're means of payment that can pay anything, US dollars, euros, or in the case of little b Bitcoin, a new cryptocurrency called Bitcoin. So there's the means of payment thing. I'm not going to discuss that. I think Jerry will go into more detail about how all that works. I want to talk about the money, Bitcoin as money, and briefly address what things influence and ultimately would determine the value of it, because, as you all know, it's not redeemable for anything else of fixed value. Has nothing behind it but the algorithm and the market in which that operates. So the question is, what determines the value of something that someone just invented and put out there in a very clever way? The first element is that well, first of all, as an economist, of course, almost everything is described in terms of supply and demand. The interaction of supply and demand determines the price or value. In the case of Bitcoin, it has a very clear, well understood, and I think well trusted algorithm for determining its supply. That's the Achilles heel of most monetary systems, that those who have the monopoly of producing a particular money invariably wind up, for one reason or another, producing too much of it, and then its value plummets. This cannot happen to Bitcoin. It has an absolute maximum quantity, which I think is 21 million Bitcoin approximately, which is expected gradually to come into being by 2040, 41, 42, something like that. So the supply side is clear, well-defined, and well-controlled. That doesn't mean it has any value. There has to be a reason for someone to demand and hold it. As money, money has value. Value has so many meanings. Money is useful as money when it enables you to pay for things conveniently in a large number of places. At the moment, Bitcoin is only at the bare pre-beginning of qualifying for that, if ever, because there are only a few thousand places that will accept Bitcoin, other than other people just trading them between themselves. So to actually pay for anything. But this is an aspiration that over time, everything starts somewhere. The number of businesses, contracts, pricing that adopts Bitcoin will grow, and with that, the usefulness of it in actually making payments to those growing number of places that will accept it is an extremely long way from even getting close to something like that. And I personally doubt that it ever will, but that would be the process that would expand the potential demand for holding Bitcoin. Money of any sort, US dollars or whatever, and the idea that it's digital or paper is totally irrelevant to anything. Money to be used has to be available. You have to have it at the time of using it. And if you just think of the typical household, you have a salary that comes in twice a month or once a month, so you get a big lump increment to your income, some of which you will continue to hold as money because your payments are staggered throughout the period, and you have to have it in order to make the payment. That gives rise to an inventory demand. Like any business that manufactures something and sells something, you have to have an inventory, because if you don't have it on the shelf to sell, you can't sell it, or you can take orders and so on. But anyway, you get the idea. The demand for money derives from the fact that it is what you need to have to make payments, and the mismatching of the inflow and outflow of your income and money, and therefore the need to have an inventory in it. That inventory is the demand for that currency. So for Bitcoin to generate that kind of a demand, it has to be broadly usable, and at this point, I'm sure anyone who's thought about Bitcoin at all has looked at its price behavior since its origins, which has been amazing, from virtually zero up to over $1,000, dropping back down to around 400. Now it's 600. I didn't have internet access in that hotel down the road, but so I don't know what it is today. But it's probably in the low 600. So it's collapsed if you bought it at the wrong time. It's soared if you bought it at the right time. It's been all over, but it doesn't display the kind of stability in the value that makes it a very attractive or safe inventory, which is what you have to have if you're going to use it as money. In monetary theory, when the value of money is quite uncertain, or when it's inflating rapidly, even if it is certain, or interest rates, which is an alternative cost of holding money, are high, people will economize on the inventory. They'll hold less of it. If it's very stable, then it becomes a more reasonable store of value, and people will hold more of it. This is just sort of standard inventory theory, which applies equally to the holding of cash balances. So to summarize quickly, at this point, the value of Bitcoin is not driven by anyone demanding it to make payments. Virtually everybody, almost everyone who accepts Bitcoin never holds them. Within 10 minutes or so, they've swapped them out for dollars or whatever currency they actually do their business in. So there is at this point negligible demand for Bitcoin as money. The demand is all coming from speculators who anticipate that it will take hold and flourish in the future, and therefore that its value will be higher in the future than it is now, and therefore it's a interesting investment. So at this point, it's 99.99% speculative demand. Unlike speculation in the markets you all are more familiar with, the speculation but I'm a major skeptic that any privately created money, especially one that is not firmly and credibly anchored to something else, like gold as a historic example, that none of them will ever succeed in displacing government currencies. Some government currencies pass away because they're so badly mismanaged, hyperinflation, Zimbabwe and Germany and Hungary and so on, but most of them are, in recent decades, managed well enough that nobody would generally wish to give them up for something like Bitcoin. But I love seeing it out there competing.
Thank you.
Okay. I can't resist doing this. I'm just going to. Yeah, so Warren said, well, he's the economist. Now, it is true. I can read computer science magazines. I mean, I've written in computer science magazines. I can read computer science articles. I don't write them. I write economics articles, actually. So I'm an economist, too. Warren and I come down on different sides of this to some degree, I think. I'm not really going to emphasize that. What I'm going to do is really talk about my answers to 3 questions, and then we can talk more about them. One question is, this is a big question for me. This is a private currency issued by people. It's irredeemable currency. It's like if I print up Jerry Dwyer dollar bills and I just pass them around to everybody in the room. You know, I don't pass them around for free, by the way. I let you give me things in exchange. That is, then would that be adopted as a currency by the world? I think the answer is no. You know, that as Warren says, in the past, generally speaking, irredeemable paper currency has a horrible reputation and it deserves it. The currencies that have lasted actually have been redeemable. That is, you can exchange them for gold or silver or something else. Bitcoin you can't exchange for anything. So a big question to me, personally, as an economist is this just a passing fad, or in other terms, is it a bubble and it's destined to fail? That is, there's no equilibrium where this stuff has positive value. And the answer to that is the way it's designed is that there are equilibria where it has positive value, as a matter of fact. That is, as long as people want to hold it and use it for something, then you can have an economy that persists forever in which it has positive value. To me, that's an important question, because the obvious answer would be, you know, the rules are set up in such a way they're not going to print up an infinite amount, but nonetheless, you could easily imagine that it's just going to pass away. And there is sort of a side issue, which is that you can create alternative cryptocurrencies. That is, it's limited to 21 million for Bitcoin, but you can have 1 million different cryptocurrencies. There's zero marginal cost to start. Right? You can get the software. You can download it off the internet. You just change the rules a little bit if you feel like it, or you go with the same rules and you start your own currency. And so what's to prevent free entry driving the value down to zero? Basically what it takes is that people distinguish these currencies. That is, that it's like Goldman Sachs is a little different than UBS. People don't say, they're all the same. You know, and these currencies have to be distinguishable in equilibrium, and all of that works. So that's one question. One question that Warren talked about is it has a volatile value. That's related to its being irredeemable. There's an alternative. It could be redeemable. That's like commercial banks. The way it worked was you gave them money, and then they promised to give you gold back in the 1800s. They promised to give you gold or silver in exchange. In fact, they were required by the government to do that. And so Bitcoin could operate that way. Well, what happens if you have that? There's a non-zero probability that they're not going to have enough gold or silver if everybody shows up. That's what happens. It's called bank runs. And so realistically, the alternative is you could imagine having redeemable private currency, but unless it has 100% inventory, and everybody believes that, and then you have to pay storage fees for the currency, then it's not going to work, and it wouldn't. And so a variable value actually makes more sense. Now the question that arises is, well, this is a highly variable value actually. I'll advertise a little bit. I actually have a paper on this that's available on SSRN or at my website if you just Google my name. And the thing is what I did was I looked at the value. You can get prices per Mt. Gox. You can actually get prices from other exchanges too. What's the average volatility of returns from holding Bitcoin? These are daily returns. It's 5% a month. The average for a month is 5% a day. All right, which is pretty high if you sort of think about diversified portfolio of stocks in the U.S. I sort of get in mind 1% is sort of a typical standard deviation that you would get. So that's pretty high compared to that. But that's not really very pertinent, right? It's not, it could be a different, just another asset class. Some people think of it that way. But you can also think of it as well, how does it compare to gold, for example? Well, it turns out it's higher than gold. Gold is more on the order of about 1 to 2% a month. The daily return averaged over a month is 1 to 2%. So that's lower. It's not dramatically lower. It's not order of magnitude lower, actually, as a matter of fact. And so if you tied Bitcoin to gold, it would lower the volatility, that's true, but not all that much. You know, and the thing is that part of what's going on with Bitcoin is it's new. And so you get big developments. People think that there's something going on in China or whatever, or that the Financial Crimes Enforcement Network is going to shut everything down. So you get big fluctuations in value because you have these big events. And they're not necessarily ongoing things as the currency exists. You can also compare it to other currencies as well. And there, it is an order of magnitude more volatile. That is, what I did was I just took the daily currency prices that are available at the Federal Reserve Bank of St. Louis for 17, in some ways, oddball set of countries. It included Sri Lanka for whatever reason. And just calculated the volatility there, you know, and the volatility there is an order of magnitude less. It's like 0.5% on average, or 0.1%. The range actually does extend up to that. There's another question, this is really big in the Bitcoin universe right now, is well, would regulation be a good thing? You know, oh, we just want to be regulated. That's what we want. It's like, my response to that, to be perfectly honest, is what planet are you from? It's like, what would regulation do for Bitcoin? There's two possibilities, all right? The kind kind of regulation you get in general in finance, like in banks, is you have to ask permission before you do anything. All right? What they're really looking for is some kind of external certification that that what they're doing is not totally off the wall. But realistically, to do that, what has to happen is just things like, if you're operating an exchange, it's a good idea to have an audit once in a while. Mt. Gox was run by a programmer. As far as I know, they never had a business person involved in it. Somebody whose career was operating businesses or anything like that. And they never had an accountant, as far as I know. And so, if you want people to operate with your business, then you have to, you can provide certification without it being from some government. The other thing is consumer protection. There's no doubt whatsoever that, for example, if you send your money off to Mt. Gox, they don't exist anymore, but BTCE or Bitstamp is, you might not get it back. That's possible. If you look on the website, you know, I looked on Mt. Gox. I thought about buying some actually on Mt. Gox, and the thing is, well, you send the money and what do they do with it? Well, they didn't really tell you. Pretty much nothing. It's like you send them the money and then you can use it to buy Bitcoins. And do you have a segregated account? No, they didn't say that at all. No, and they didn't. As some people found out to their regret. So that's my summary. Thank you.
Thank you.
I appreciate the thoughts of the panelists, and frankly, I agree with a lot of them. We'll start with the basic concept of what is Bitcoin. It's a popular misnomer that Bitcoin is a currency. Bitcoin is not a currency. Bitcoin is, it's not a security, it's not a currency, it's an asset class. Kathleen in the beginning asked about thoughts on what will win and what will fail. I have no view on whether Bitcoin itself will win or lose the day ultimately. What I have come to believe is that the digital asset class, the virtual currency class, the cryptocurrency class, that's a new asset class that we're seeing starting to emerge now. And the reason it's an interesting class is it undercuts the payment processing system that currently exists. If you wanted to buy goods or send money overseas, the time lag and the cost associated with that is astronomical given with the relative ease associated with the transaction. What Bitcoin allows one to do is to send a payment system overseas instantaneously. That is a profound concept. That is as profound as email was 35 years ago. And it disintermediates the middleman, whether the middleman is American Express, Western Union, Visa, Chase, whomever it is, they're all knocked out of the picture. That's $1 trillion a year business that can be undercut with this simple technology. I don't advocate that Bitcoin is a currency. I think if you look at what Bitcoin is, and we spent a fair amount of time looking at this, it is a capital asset. It's a commodity. And that's the most important concept of thinking about what Bitcoin is. And why do I say it's a capital asset or a commodity? For the reasons that Dr. Coates and Professor Dwyer explained. There's a limited amount to be created, 21 million in total. Of that, 90% will be mined by 2020. The remaining 10% won't be mined until 2140. So like gold or other commodities out there, there's a difficulty associated with mining. And that difficulty expands on a regular basis. In fact, I believe it was last week or late the week before, the formula, the complexity of the mining operation increased 1 billion times off of the prior generation. That's a radical step forward in the process. And the reason they do that is based on the regression theory of Bitcoin, which is every 4 years, half the number of coins will be mined as in the 4 year prior. So the system's streaming down already. To date, roughly 12.8 million Bitcoin have been mined, and that's now in the downward cycle of how much will be mined going forward. The complexity associated with mining has also changed drastically over the last 5 years. If you go back to circa 2009 or so, a hobbyist with a CPU in their garage could mine their own Bitcoin. That evolved in late 2010 to a GPU. Then in roughly 2012 or so, it became a server. At this point, to mine Bitcoin, one would need dedicated systems that have been specially built to mine Bitcoin. The energy cost associated with mining Bitcoin is significant to the point that American companies don't mine Bitcoin because the energy cost would devastate the business model. Bitcoin is being mined in geothermal or energy efficient zones, whether it's Iceland and Greenland, whether it's off the coast of Asia in wind farms, or in the Mojave and solar farms. That's the challenge associated with mining Bitcoin is on par with the challenge associated with mining gold. If you look at the gold prices historically, gold prices have shifted as mining gold became more and more difficult and as gold supply started to limit. What can one do with Bitcoin? Yes, one could use Bitcoin to buy goods. I think the optimum use of a Bitcoin, if you look at Satoshi Nakamoto's white paper from 2007, he conceptualized more the Bitcoin network than the Bitcoin themselves. And when I say the Bitcoin network, it's what Dr. Coates referred to as capital B Bitcoin. It's the underlying software protocol, which when it was first created was a dramatic step forward because it did not allow chargebacks. One of the biggest problems in the credit card processing system is chargebacks. Fraud, chargeback, call it whatever you want. In Bitcoin, it's a knowledgeable transaction to send the Bitcoin out and a knowledgeable transaction to receive the Bitcoin. To quote my 5-year-old, there's no backsies. It's a one-way transaction in Bitcoin. And that's what makes this digital asset most interesting going forward. It's the applications on an international basis, whether you're a retailer in the U.S. paying their supplier overseas, instead of dealing with the time lag in wiring the money, it can happen instantaneously. And yes, I agree with Professor Dwyer that people don't hold Bitcoin because there's no reason to hold Bitcoin. What you can do with Bitcoin is you can convert it to your fiat currency once you get it. So as a store of value, I don't think Bitcoin is the end-all and be-all. I think what you've seen from a movement standpoint is adoption occurring as people are buying into the system and using the system to process and transmit payment. There are those who believe Bitcoin is an end unto itself. There are those who believe it mirrors and is akin to a currency, and there are those who are going to use it to pay for goods. And in that regard, the IRS came out with their pronouncement in late March, which equated Bitcoin again to a capital asset and equalized it to a barter transaction. And there's tax treatment that can be applied both on a short and long-term gain. And that's an important understanding of how the government looks at Bitcoin. There's an act that I heard last summer about conversations that went on down in Washington shortly after the Bitcoin ETF was initially filed about who would be responsible for it going forward. And it was basically a hot potato. No one wanted to touch it. And under the ensuing months, the Chicago Fed put out 2 white papers on this. Chairman Bernanke said it was not under the Fed's jurisdiction. Treasury said it's not in Treasury Maine, it's in FinCEN. ATF said, well, it's not a currency, so Secret Service didn't want to touch it. So all these groups don't want anything to do with it because it's popular based. Its value is derived from what people believe and what people want to use it from a processing standpoint. And I don't believe Bitcoin's been designed to challenge the US dollar. I don't believe it's designed to challenge the yen or the euro or the pound. I believe it's created as a safe haven for people who are in economically challenged zones, whether it's South America or Sub-Saharan Africa or other places where their local currency is in jeopardy, that they can use this as a flight to safety because they can then convert it to a euro or to a pound or to something else and not necessarily worry the same way if they're holding their local currency. When Katherine first started focusing on Bitcoin last year, Kathleen and I presented to our partners about the opportunity and the concept, and one of the questions was, well, why do I want Bitcoin? My response is, you, a lawyer sitting in Midtown Manhattan, you probably don't, but it's not designed for you. If you're your contemporary sitting in Argentina or sitting in Cyprus 3 years ago, yeah, Bitcoin has a lot of value for you because it's going to give you a way to avoid whatever domestic risk is occurring in your local jurisdiction. And that's where we see the digital asset class going. Not as an independent store of value, not as a replacement to a currency, but as an alternative to gold. And as we see buy-in occurring now on an institutional financial level, the people we see attracted to it are people who look at it as an alternative investment opportunity. They like the speculative nature, but they look at it as a gold contemporary. And that's frankly how we view it from a regulatory standpoint as well. If you think of what regulation would apply, you can draw a lot of analogies. If you want to look at domestic regulation in the space, again, there's limited regulation coming out of the federal level. I think what you'll see is a lot of regulation at the state level. And from a state standpoint, where's the proper place to regulate? We've had a number of conversations with regulators on this point. Our feeling is the choke points. The choke point being the conversion between digital and fiat and back again. And the reason you regulate that level is to prevent crime, right? What is government regulate for? To prevent crime and to protect ignorant investors. If you can focus and make sure they're sophisticated and understand the risks they're taking, and also to limit its uses in an illegal method, I think government can serve its proper mandate. And that's why we focus on the choke point being the exchanges as the most likely place of regulation. And frankly, I agree. Mt. Gox had a lot of problems. I think we're the first to say that there's a litany of issues at the Mt. Gox level, from both a lack of institutional awareness to a lack of proper oversight to a lack of basic controls and procedures. The people who want to see U.S. regulation want to see a U.S. exchange. And I think when you do see the U.S. exchange, you'll see more institutions, a greater understanding of the risks associated with it, and that will ultimately make it a stronger asset class.
Thank you. You prompted me to think of something, and I'll just ask the panel if they have any reaction. I mean, I've heard what Evan has said, which is that the immediacy of the payment and the inability to charge back and the lower costs associated with Bitcoin and other cryptocurrencies mean that it will have a far advantage over American Express or Western Union or whatever. What would prevent Western Union or American Express from reducing their costs to try to compete with those cryptocurrencies?
Nothing, and I think they will. And things like Bitcoin will put some fire under them to do so more dramatically. But I want to challenge the presumption that because the cost of my buying some Bitcoin that I want to send to someone in Kenya, and hopefully I can come back to M-Pesa at some point, it is cheaper than Hawala is quite expensive, actually. Their Western Union is cheaper than the Hawala system, and so on. But cheaper than, it's not cheaper unless, even though getting the Bitcoin to my recipient in Kenya would be cheaper, but that's not the full cost of my recipient actually getting usable money. Either the Bitcoin he receives is widely usable within Kenya as money, and he can directly pay things with it, in which case it is dramatically cheaper. But that's not the case, in my opinion, not likely ever to be the case, and therefore my recipient is going to have to find somebody else there who is willing to sell him Kenyan shilling for the Bitcoin so that he can actually pay for what he needs to pay for. That can be an expensive process. So don't cut the analysis of cost halfway. Getting the Bitcoin to Kenya is only a small part of the cost, and it's not clear that it's cheaper. The thing I want to add to that is that, because we're talking about people not holding Bitcoin very long and swapping them out as soon as they get them, every Bitcoin that has been created and issued must be held by someone if Bitcoin is to have a positive price at all. So while the normal user and transactor doesn't want to hold them because of their unstable value and swaps out, there has to be someone who's willing to step in and hold them. Those are the speculators at this point. Without them, Bitcoin would have zero value.
Well, I'm not sure it's the speculators so much who are buying them up as much as third-party companies who's focused on this business. Whether it's BitPay in the US or BitPagos in South America, they have peers around the world. And they're stepping in, they're buying it, they're holding it for their own interests, they're reselling it back into the market to others. So it is a full circle, it's a closed loop. So it's not being bought up by the speculators. At some point, yes, there are speculators in the process. I think there are many speculators, frankly. But I don't think that there are businesses whose sole design is to do that. And frankly, I felt that if I was going to take a hiatus from practicing law, that'd be a great business to go into right now, to go out there and become one of the people buying it up, because there are a lot of dislocations in that market. I think getting back to Kathleen's original question, though, why won't Amex lower the price of Western Union? The cost of goods for them is too significant. The personnel, the real estate, the utilities, it tacks on and on. You don't have that in the Bitcoin world. So yes, they can lower their costs, but it'll only go so low. And something that's, again, like email, that's instantaneous and free will always be cheaper. So while I agree again with Dr. Coates that there is some challenge potentially in holding and using the Bitcoin at this stage, I don't necessarily see that for an indefinite future, that issue. And we are starting to see, especially in the third world and second world, more countries and more situations where people can use Bitcoin as an alternative. In fact, there's a number of examples in Kenya and other places where there are not just Bitcoin, but other concepts like that. I've heard one business where people are trading cell phone minutes as a means of payment. So the concept's coming about because the people and the populations are demanding it. They need a way to live their lives in a more of a barter-based system.
Time to say something more about M-Pesa,
yes.
which is the stunningly successful mobile phone payment system in Kenya, and similar models developing in some other places. But this has been transformative in Kenya. There are, I'm guessing, rough orders of magnitude, twice as many M-Pesa accounts as there are banking accounts in Kenya. It's lowered the cost of making payments dramatically. But what I want to emphasize is that M-Pesa is not a currency. It's a means of payment. It's a means of transferring Kenyan shilling, which is the government or the central bank of Kenya's currency. It's a means of a much more efficient, lower cost means of transferring it from one person to another. And this distinction between the technologies that can lower costs of means of payment and the creation of alternative currencies is fundamental to this whole discussion.
Well, it seems to me that, just reading sort of popular literature, if you will, that people, let's say, not professors and not lawyers, but the general public uses the word currency to mean a means of payment. Because I see it all the time. They'll be talking about, Bitcoin or some altcoin, some kind of altcoin as a currency, and they're really not talking about it in the strict terms that we would be talking about it. They're using it more as, if I give you this, I can get this from you. A means of exchange, I think.
But the two parts of that are the way you give this to them to affect the payment and what it is you give them.
I agree with you, but I think that that's conflated a great deal in the popular press. Absolutely. And actually, it's been sort of discouraging to read the popular press on this topic because being involved with registering a securities product, there's a great deal of disclosure that has to go on. So all of us have read enormous amounts of material on these various subjects, and then you read the press account of what you've written, and it's so far off base that you sort of want to cry, basically. In any case, and another question that's come to my mind recently is we have a lot of altcoins or other cryptocurrencies being built on top of Bitcoin or on top of some other altcoin. Does that make the analysis more complicated, less complicated? Doesn't make any difference?